After studying this module, you shall be able to learn how to measure a country's openness to international trade, understand and compare the terms nominal, real, and real effective exchange rates, distinguish between bilateral and multilateral exchange rates, know the concept of depreciation and appreciation, or devaluation and revaluation, and understand their impact on prices of exports and imports, recognize different exchange rate regimes, fully flexible, fixed, and managed floating, understand the working of foreign exchange markets under flexible exchange rates, comprehend the theory of purchasing power parity.
In this era of globalization, all the economies are open to international trade and financial flows, though maybe in varying degrees. International trade provides consumers and firms the freedom to choose from a diverse range of goods and services produced within the country as well as abroad. Therefore, in a globalized world, the investors can also choose similarly between domestic and foreign assets. Although restrictions on international trade and financial flows still exist in the form of taxes, tariffs, controls on labor and capital movement, however, their levels have been going down significantly in recent years, which means the tariff levels, etc., or all these artificial barriers are trying to be reduced over their recent years. Efforts are consciously made to make these barriers less restrictive. In India, prior to 1991, the economy was heavily regulated, with numerous trade restrictions and capital controls limiting the degree of openness of the economy. However, with the reforms of 1991, the economic situation has changed dramatically now. There has been an increase in the degree of openness of the economy, as is evident from various measures of openness. And I'm sure you would appreciate and see that how this has happened over the years. These measures are therefore discussed in the next section.
Openness of an economy refers to the degree of freedom to exchange goods and factor services, capital and labor across national boundaries. The greater is this freedom, the more open the economy. In recent years, with globalization, there has been greater integration of all major economies with the rest of the world. As a result, the proportion of trade to world GDP has been rising. It would be of value to measure how open an economy is. Some of the measures that could be used are share of foreign trade. It is the sum of exports and imports of a country expressed as a proportion of its GDP. This is most widely used as an indicator of degree of openness of a country. Value of import duties as a proportion of value of imports. This is often used as a measure of openness. A fall in this ratio indicates lower import restrictions and hence suggests that the economy is more open. An open economy also engages in purchase and sales of financial assets, capital inflows and outflows on the capital account. Measures similar to 1 and 2 listed above have been suggested that try to capture openness on capital account by the value of capital asset transactions as a proportion of GDP. Some indices attempt to measure the stringency of restrictions on cross-border financial flows. The currency of another nation that is required for international transactions is called foreign exchange. Countries earn foreign exchange by exporting and use it up in buying imports. The trade balance of a nation is the difference between exports to foreigners and imports from them. A nation will have a positive balance or trade surplus if its exports exceed imports, and it will have negative balance or trade deficit if its imports are greater than exports. In the case of trade surplus or deficit, one of the nations has to make payments to the other nation in the foreign currency or ask for credit. Since all these transactions across international borders involve the use of foreign exchange, it is extremely useful to understand the concept of exchange rates between different currencies.
The exchange rate between currencies can be defined as the number of units of domestic currency which in our case is rupee, required to purchase 1 unit of foreign currency, let's say dollar. For example, if rupees 60 is required to buy a dollar, then the exchange rate is $1 is equal to rupees 60. Similarly, the exchange rate of the Indian rupee can be defined in terms of all other currencies of the world such as yen, euro, pound sterling, etc. It is therefore important to know about the changes in the values of exchange rates. When the exchange rate changes from say rupees 60 to $1 equal to rupees 55, the foreign currency gets cheaper. It costs less, which means now it takes rupees 55 to buy $1 compared to the earlier case when the price of dollar was higher in terms of rupees, let's say 60. In this case, we may say therefore that rupee has appreciated vis-a-vis dollar and dollar has depreciated vis-a-vis rupee. Now note in this case, dollar has depreciated and $1 now buys less, which means rupees 55 in terms of rupees compared to the earlier situation when it bought more, which was rupees 60. A country's currency could appreciate or depreciate due to various reasons linked with macroeconomic phenomena such as inflation, interest rate, or balance of payment positions, etc. I am sure you would appreciate and you would be able to understand some of these subsequently.
Nominal exchange rates. The concept of exchange rate we discussed just now is referred to as the nominal exchange rate between dollar and rupee. Let us denote this by E. That is, E is the price of foreign currency in terms of the domestic currency. Continuous changes take place in the nominal exchange rate, E, when exchange rates are freely floating and their value is determined by the relative demand and supply of domestic and foreign currency. When the nominal exchange rate E rises, say from $1 equals rupees 60, it becomes $1 equals rupees 65, there is an increase in the price of foreign currency, dollar, in terms of the domestic currency, rupee, and there is a nominal depreciation of the domestic currency, rupee. When E falls, say from $1 equals rupees 60, it becomes $1 equals rupees 55. There is a fall in the price of foreign currency, dollar, in terms of domestic currency, rupee, and there is a nominal appreciation of the domestic currency, rupee. In many cases, exchange rates are not freely floating but are fixed by the government. In a fixed exchange rate system, two or more countries maintain a fixed parity or constant exchange rate between their currencies over a period of time. The fixed parity is often revised from time to time. The counterparts of appreciation and depreciation under the fixed exchange rate system are referred to as revaluation and devaluation. Thus, in a fixed exchange rate system, decrease in E due to official intervention is called revaluation, while an increase in E by official intervention is called devaluation.
So after discussing about nominal exchange rate, let us now move over our discussion to real exchange rate. In open economies, we are also interested in measuring the rate at which the domestic goods can be exchanged by foreign goods. This can be measured by computing real exchange rates. It is called real because it refers to commodity exchange rather than currency to currency exchange as in the nominal exchange rate. Thus, the price of foreign goods relative to that of domestic goods is referred to as the real exchange rate. This is not directly observable but can be easily constructed using information on prices of a basket of domestic and foreign goods and on nominal exchange rates that are readily available. So, why are real exchange rates useful? This may be a question which may be bothering some of you and which I am sure most of you would be curious to know. To an Indian importer, one who is importing from abroad, it is of great relevance to know how much goods he can buy from the US, for example, which depends on the nominal exchange rate as well as on the dollar price of American goods. This information is provided by real exchange rates. Why? Let us understand it. The rupee dollar real exchange rate reflects the relative price of goods produced in US relative to those produced in our home country. The prices of a basket of goods are measured using a price index such as GDP deflator. So if P denotes the price index for India and P star that for the US, then the real exchange rate, which is the price of US goods in terms of Indian goods denoted by R, can be computed as R is equal to E into P star upon P. In words, we can say the real exchange rate is computed by multiplying the foreign price level by the nominal exchange rate and then dividing by the domestic price level. So if the real exchange rate is equal to 1, then the nominal exchange rate is such that the cost, which is expressed in terms of a single currency of a basket of goods, is the same in two countries. In this special case, the nominal exchange rate is set to maintain purchasing power parity. Please remember, we said this is the case where the exchange rate, real exchange rate, is equal to 1. However, if the real exchange rate is greater than 1, then the rupee price of foreign goods is higher than the domestic goods, which means foreign goods are more costly than Indian goods. And in this case, the demand for Indian goods would be higher because Indian goods are relatively cheaper as compared to the foreign goods. In general, an increase in R indicates that Indian goods have become cheaper relative to foreign goods, and that should boost our exports. I am sure you would agree with that. This is why the real exchange rate is often used as an index of a country's international price competitiveness. Similar to nominal exchange rates, there are continuous movements that take place in real exchange rates also. For instance, suppose that P star and P are unchanged, but E rises, which means rupee depreciates. This would cause a rise in R. So a rise in real exchange rate, which means an increase in the relative price of foreign goods in terms of domestic goods, is referred to as real depreciation of the home currency. So I hope you understand the meaning of real depreciation of a home currency. A fall in the real exchange rate, which means a decrease in the relative price of foreign goods in terms of domestic goods, is referred to, on the contrary, as the real appreciation of the home currency. So we know what is real depreciation and what is real appreciation of the home currency. So when domestic and foreign prices remain unchanged, the nominal and real exchange rates move in the same direction. However, prices may change simultaneously with exchange rates, and an appreciation in nominal exchange rates, which means fall in E, along with a large fall in domestic prices, which means P falls, may lead to a real depreciation, which means R rises. In other words, it may happen that real and nominal exchange rates move in opposite directions.
Next is bilateral and multilateral exchange rates. The discussion till now has focused on bilateral exchange rates involving only two countries, India and the US. However, India does not trade with only one country, nor does any country in the world trade and interact with only one country. Due to this fact, the concept of multilateral exchange rate rather than bilateral exchange rate becomes more relevant. The concept of effective exchange rate therefore becomes useful. Let us understand nominal effective exchange rate. It is computed as the weighted average of nominal exchange rates with the weights as the shares of the respective countries in the trade of the home country. An example will clarify the concept. For example, if India trades only with two countries, US and UK, with respective shares of 70% and 30% in India's trade, and nominal exchange rates are $1 equals rupees 60 and £1 equals rupees 105, then the nominal effective exchange rate may be computed as zero point 0.7 multiplied by 60 added to zero point 0.3 multiplied by 105 equals 73.5. This implies that for rupees 73.5, a basket of goods containing $0.7 and zero point 0.3 pounds can be purchased. It should be noted that while calculating effective exchange rate, only the important trading partners with which we have a sizable proportion of trade are considered. Thus, a 5-country nominal effective exchange rate or a 10-country nominal effective exchange rate will consider only the top 5 or top 10 trading partners respectively. The effective exchange rate is expressed as an index number, so like any other index number, it assumes value of 100 in the base year. Another concept is that of real effective exchange rate. Instead of computing separate real exchange rates for all the trading partners, it would be useful to compute and track the overall real effective exchange rate for a country. Similar to nominal effective exchange rate, it is computed as the weighted average of real effective exchange rates of all the major trading partners, the weights being the shares of these countries in India's foreign trade. It indicates the quantity of domestic products that may be given to get one basket of foreign products. Again, only the major trading partners are considered. For example, 5-country real effective exchange rate or a 10-country real effective exchange rate can be computed using nominal exchange rates and price indices of 5 or 10 countries which are the most important trading partners. Real effective exchange rate is also usually expressed as an index with value 100 in the base year. Let us now study different kinds of exchange rate regimes. First one is fully flexible exchange rate or clean floating. When the exchange rate is fully flexible or on a clean float, its value is determined entirely by the demand and supply of foreign exchange. In this case, the country's central banks do not engage in the purchase and sale of foreign currencies in an attempt to affect the value of the exchange rate, and the exchange rate adjusts to equate market demand and supply of foreign exchange. Thus, in the fully flexible or floating rate system, exchange rate adjusts continuously to clear the foreign exchange markets. In this case, the governments have little role to play as they do not intervene to set the exchange rates. For instance, suppose the exchange rate is $1 equals rupees 60 and Indian exports to the US increase due to some reason, then the American importers who have dollars would need more rupees to pay Indian exporters. In such a case, the demand for rupees and supply of dollars would increase, creating an excess demand for rupees and an excess supply of dollars. If the Indian Central Bank, Reserve Bank of India, did not intervene and allowed market demand and supply to determine the new exchange rate, there would be an appreciation of rupee and depreciation of the dollars, resulting in fall in the exchange rate to say $1 equals rupees 55. To understand how foreign exchange rates are determined, it is essential to study the demand and supply of foreign exchange. Let us consider the market for foreign exchange, say dollars in India. Indians can buy dollars in exchange of rupees from the foreign exchange market in times of need. The figure displays a market for foreign exchange. Similar to any demand supply analysis, the quantity of foreign exchange is shown on the horizontal axis. The price of foreign exchange, that is, rupee per dollar, is represented on the vertical axis. The demand for foreign exchange is represented by the demand curve D. The demand for foreign exchange dollars arises out of following transactions. When goods are imported into the domestic economy, India, importers have to pay foreigners in foreign currency, dollars, creating a demand for dollars. The purchase of assets, example, purchase of foreign government bonds or shares in foreign companies by domestic residents leads to outflow of dollars, again creating demand for dollars. The supply of foreign exchange dollars is represented by the supply curve S. The supply of foreign exchange dollars results from the following transactions. When goods are exported to other countries, exporters receive payments in foreign currency, dollars, resulting in increase in supply of dollars. When foreigners purchase domestic assets, example, purchase of Indian government bonds or shares in Indian companies, there is an inflow of dollars or increase in supply of dollars. For simplicity, we assume that the asset transactions are exogenous and not influenced by the exchange rates. In such cases, the slope of demand and supply curves may be understood as follows. Given the prices of foreign goods, imports, and domestic goods, exports, when there is a rise in the exchange rate or the depreciation of rupee vis-a-vis dollar, exports become cheaper in foreign currency. This leads to an increase in exports and hence an increase in export earnings or supply of foreign exchange. So, the supply curve is positively sloping as a rise in the exchange rate is associated with increase in supply of foreign exchange. A rise in the exchange rate, depreciation of rupee vis-a-vis dollar makes foreign goods imports relatively more expensive in domestic currency and reduces demand for imports and hence the demand for foreign exchange. So, the demand for foreign exchange is downward sloping as a rise in exchange rate is associated with a fall in demand for foreign exchange. The figure shows how the equilibrium between demand and supply of foreign exchange determines the exchange rate in a system of flexible exchange rate. The equilibrium value is E star. The exchange rate remains at this level until there is some change in either demand or supply. But there will be a change in the equilibrium exchange rate if there is a change in any of the factors affecting demand and supply. For example, consider an increase in disposable income of Indians. This increases the demand for all products, domestic or foreign, and hence has an impact on demand for foreign exchange. Let us understand this case more clearly with the help of a diagram. In the diagram, the demand curve shifts from D to D1 as import demand rises due to increase in disposable incomes. Other things being equal, higher import demand leads to an increase in demand for foreign exchange, dollar, creating an excess demand for dollar at the initial exchange rate E. You may note that the excess demand for dollars is essentially an excess supply of rupees as people exchange rupee for dollar. This leads to a rise in price of dollars in terms of rupee or a depreciation of rupee vis-a-vis dollar. The foreign exchange market clears as the new equilibrium exchange rate E1 is reached, where once again demand is equal to supply. You may note that at E1 the rupee has depreciated as a result of the increase in import demand due to increase in disposable income of Indians. Consequent to the shift, the equilibrium exchange rate increases to E1 from its initial level E. As exchange rate rises, dollar becomes relatively more expensive and therefore there will be an increase in exports and reduction in imports. Instead of rise in disposable income of Indians, now suppose the demand for foreign asset rises, resulting in rise in capital outflow from India. Consequently, the demand for dollar will rise, causing D to shift to the right. This is similar to the earlier case of rising disposable income in the domestic economy. The impact on exchange rate E is similar. Again, the rupee will depreciate in the reverse case when the foreign demand for Indian assets rises, resulting in higher capital inflow into India. Supply of dollars in India will go up. The S curve will shift to the right in figure and rupee will appreciate. Floating exchange rates lead to considerable volatility in exchange rates that must change continuously to clear foreign exchange markets. Such volatility may be unfavorable for the interests of exporters and importers. It may also have its adverse impact on domestic production and employment. As such, pure floats are rarely observed, and in most countries, governments intervene and try to maintain the value of exchange rate within a certain band.
Next is foreign exchange rate or pegged exchange rate. An important function of central banks in fixed exchange rate system is to intervene in foreign exchange markets. Intervention means the purchase and sale of foreign exchange by central banks in order to maintain the price of foreign exchange fixed at a pre-announced level. So in order to carry out intervention in the foreign exchange markets, the central bank has to maintain adequate stock of foreign currency, or which is known as foreign exchange reserves. In a fixed exchange rate system, the central bank announces and supports a fixed exchange rate between the two currencies by buying or selling foreign currencies in the foreign exchange market at that particular rate. Say for example, in a fixed exchange rate regime, if there is an excess supply of rupee and an excess demand for dollar, to prevent a depreciation of the rupee vis-a-vis dollar, RBI will sell dollar and buy rupee. It would do so till the excess supply for rupee and excess demand for dollar is eliminated, so that the exchange rate remains fixed. So it is a simple demand supply mechanism which would try to maintain the constant exchange rate or the fixed exchange rate.
To see this, look at Figure 3. The equilibrium exchange rate determined by the demand and supply of foreign exchange is E star. However, if the central bank fixes the exchange rate at E1, then there is an excess supply of dollar in the market. As the exchange rate is high, Indian goods become relatively cheaper, and hence demand for such goods is relatively high compared to foreign goods. This creates an excess demand for rupees and a corresponding excess supply of dollars. In such a case, the central bank stands ready to buy excess dollar in the market. In the reverse case, when the exchange rate is fixed at E2, then there is an excess demand for dollar. As the exchange rate is relatively low, foreign goods are relatively cheaper. Hence, there is excess demand for dollar and corresponding excess supply of rupees. In this case, the central bank stands ready to sell dollar. However, the central bank cannot do this indefinitely, as its own stock of dollars or foreign exchange reserves would be limited. Occasionally, central banks announce a change in the fixed parity. They may either devalue or revalue the domestic currency depending on the macroeconomic situation. In the case of devaluation of the rupee, the price of foreign currency increases. Example, from $1 equals rupees 60, the fixed parity becomes $1 equals rupees 75, while foreign currency becomes cheaper in the case of revaluation of the rupee. In a world with few restrictions on international transactions in goods and assets, maintaining a fixed exchange rate poses an immense challenge for a country's government.
Next is managed or dirty floating. In the managed or dirty floating system, the exchange rate is allowed to fluctuate within specified bounds. Thus, it combines elements of both the flexible exchange rate and the fixed exchange rates. In a managed floating system, central banks maintain optimal stock of foreign exchange reserves, and then they intervene to restore the value of the exchange rates whenever there is a tendency for it to deviate from that desirable range, which is, as we have said, is fixed by the central bank of a country, RBI in case of India. Now, given these three exchange rate regimes, the world is still looking for an ideal exchange rate system. An ideal exchange rate system would be one that enables exchange rate stability, freer international trade, lower inflation, and a stable global economy. With the breakdown of the international fixed exchange rate system in 1971, known as Bretton Woods system, Indian rupee was linked to British pound. In 1975, it was linked to a basket of currencies rather than a single currency to avoid too much volatility. The 91 reforms also brought to an end to the fixed exchange rate regime in India. Currently, in India, the managed float exchange rate system is generally maintained. RBI intervenes often in the foreign exchange market to maintain stability of exchange rates. The most active intervention was during the global financial crisis of 2008, in which it sold 20.6 billion in the market. I'm sure you are all familiar or must have heard about the global financial crisis. So though over time rupee has depreciated against dollar as well as against other major international currencies, however, under the managed floating system, there has been lesser volatility in the Indian exchange markets.
Let us now understand the concept of purchasing power parity theory. The theory of purchasing power parity (PPP) predicts that the exchange rates between two countries will adjust in the long run in accordance with the price differences in the two countries. This is based on the assumption of free trade and fully flexible exchange rates. In simple terms, it states that the same product will sell at the same price in all countries, excluding the differences in transportation costs. Accordingly, this theory is also referred to as the law of one price. Suppose you can buy a basket of commodities at rupees 600 in India, and suppose the same basket costs $10 in USA, then, according to the purchasing power parity theory, the rupee dollar exchange rate should be $10 equals rupees 600 or $1 equals rupees 60. Suppose instead the market exchange rate in such a case is $1 equals rupees 50 or $10 equals rupees 500, then this leaves room for making profits. One could exchange rupees 500 for $10 and buy the basket of commodities in US at rupees 500 and sell it for rupees 600 in India, making a profit of rupees 100. According to the theory of purchasing power parity, such arbitrage opportunities would be exploited, leading to a rise in the demand for dollar to acquire the cheap American goods and corresponding supply of rupee. This would lead to a depreciation of the rupee and an appreciation of dollar, pushing the exchange rate from $1 equals rupees 50 towards $1 equals rupees 60. Once the latter exchange is attained, all arbitrage possibilities would cease to exist. The purchasing power parity theory does not explain the exchange rates at a particular point or period of time, but explains a long run tendency for exchange rates to settle at values that reflect good prices. The inability of purchasing power parity to hold in the short run could be explained by the existence of restrictions such as natural barriers, example transportation, or trade controls, example tariffs, quotas, across countries, and non-comparable products that are sold across countries. Further, certain products cannot be moved and hence are non-tradable across borders, example land. It is not possible to equalize their prices internationally.
So students, let us now summarize what we have learned in this module and introspect what has been done so far. Most economies we have learned are open today and they are linked globally through trade and financial markets. We have also seen that how the nominal exchange rate is the price of the foreign currency in terms of domestic currency. However, we have seen the importance of real exchange rate, which is nothing but the price of domestic goods relative to that of foreign goods. We have also learned that a decrease in nominal exchange rate, which means nominal appreciation of domestic currency implies that fewer units of domestic currency are required to obtain 1 unit of foreign currency. On the contrary, an appreciation makes the country less competitive and consequently its imports rises and exports fall. So I'm sure you can understand what is good or bad for a country, appreciation or depreciation. An increase in the nominal exchange rate, which means a nominal depreciation of domestic currency, implies that more units of a domestic currency are required to buy a unit of the foreign currency. A depreciation makes the country more competitive, increasing its exports to rest of the world. And that is why many times some of the countries in the world are tempted to depreciate their own domestic currency so that they are able to increase their exports to the rest of the world. However, in a flexible exchange rate system, the central bank does not engage in purchase and sale of foreign currencies, and the exchange rate will adjust to equate market and demand and market supply of foreign exchange. I am sure you have learned this very carefully. We have also learned that under the fixed exchange rate regime, the central bank stands ready to buy or sell currencies at an officially announced rate. Its stock of foreign exchange reserves will change therefore in this process of buying and selling of currencies. I am sure you all can understand this. We have also learned in the managed or dirty floating system, the exchange rate is allowed to fluctuate within bounds. Therefore, it combines elements of both the flexible exchange rates and the fixed exchange rates, which are, you may say, the two extremes. The purchasing power theory, which is PPP, asserts that the exchange rate adjusts to equalize the price of similar goods internationally. It therefore assumes absence of transport costs and trade barriers.